Ron here from the hit podcast, The Other Side of Wall Street. And if you're like most of us here in the trading community, you no doubt have mentors or experts that you look up to for trading advice and knowledge. Well, how many times have you wished you could just sit down with one of those experts and have a good old one-on-one conversation with no script, no planned questions, just a friendly chat? Well, that's what we're bringing to you here. Each week, we'll visit with a different expert and have an up-close and personal conversation about anything and everything involving trading. So sit back and enjoy as we get to know our special guest. So back to selling options. Like I say, I have so many questions I want to ask you, and I wrote them down in no order. When you put a trade on, or when you suggest to your clients they put a trade on, how do you manage the risk? Is it purely stop loss related, or do you have adjustments you can make if the trade goes against you? Anyway, so how do you manage, if the market turns and goes against you?
Sure. Well, I think as the saying goes, every battle is won before it's fought. I think a lot of it is the research going into the trade, which is why for the research stuff, I rarely will adjust stuff. We get in, and then if the trade doesn't work, we get out. And there's getting back to psychology, I think there's a psychological problem with adjusting for a lot of people, because what you're really doing, if you get right to the root of it, in my opinion, if you're adjusting, unless you're taking profits along with you or something like that, but for most people try to repair, all you're doing is you're not admitting that you're wrong. And so that's why I like to basically get in and we get out, and it's worked wonderfully well over in that particular strategy for 18 years without getting it too complicated. But the risk management is really a function of and again, I'm not in the business of top or bottom calling. I don't think that's a good business to be in. But it's about picking your spots correctly in the sense where you give yourself good odds. So when you then get below a certain point, if you have a bullish position, or above a certain point, if you have a bearish, you just need to get out. So, but the risk management with selling options, in my opinion, can only be done if you give yourself enough time and enough space to be wrong. So in other words, let's say you have a stock that's trading at $100 right now, and you think it's going to not go a lot higher because it just went vertical. In the current world, there's a lot of those examples. You could make several bets. You could sell, you could short the stock, right? In which case you make money if it goes lower, but it has to go lower, otherwise you don't make a penny. You could buy a put, right? Mm-hmm. Fine. Again, you'd make money if it goes lower, but it has to go lower. So there's a 1/3 chance of you making money, right? Because the stock can do two other things. The stock at any given point can either go down, sideways, or higher. That's the only two things it can do. And if you at that point short the stock, you have a 1/3 chance, just from a purely statistical perspective. Now, I just don't think that's good odds. So what we like to say is, okay, we think the stock could go lower, but instead of making that bet, I'm just going to say, you know what? I don't think it's going to go much above, let's say, $110. That's 10% to the upside. So purely on paper, if you will, or just academically speaking, you could be 100% but make it wrong, and the stock could go against you to theoretically up to 10%. You could still make money, right? And so that's really the way we manage risk, but also that's the stop loss. That's the space. I said you want to have two things when you manage your risk. You want to have space and time. That's the space bit. But really, quite frankly, the time bit, and I'd love to hear, if you found this as well, but the time bit is I think is by far the most important, because so right now it's January, let's say, and a lot of people that are selling options would right now use options expiring, let's say, in February, or God forbid they use a weekly option, which is basically nuclear risk.
Right.
So what we like to do is we like to say, you know what, let's use at the very least March, probably and preferably April options right now to make that bet. But, and this is the big difference, we'll only keep this trade on 2 weeks on average, no, maximum 3, probably 2 weeks. Because what people don't understand when you short options, whether it's a spread or an option, the longer you're in that trade, the more binary it becomes. Mm-hmm. So there's the time decay thing that people say, oh, you got to sell out short options, and that's why you sell the weekly options expire next week, and the time decay, yeah. But if you sell a weekly option and you're sitting on that expiration Friday, it's a nail biter. You're either going to make money or you're going to take basically a maximum loss.
Mm-hmm.
And that's, to me, that's not trading. That's a gamble. I don't know. What do you think about that?
No, I tend to agree with you, but also at the same time, I have to admit that I believe in shorter term options. I try to go after the quick theta decay.
Okay.
I decay the quickest, closest to the end. So we sell 10 we try to stick around 10 deltas. So give us a 9% chance of expiring.
And so you go way out of the money.
And way out of, yeah, we sell junk.
Yeah.
But
do you do that on stocks or indices, or how do you do that?
Pretty much SPX.
Okay, that's a bit different then. I'm more referring to people doing it on individual stocks, right? Where I think that becomes much more of a risk.
So my go-to strategy on individual stocks is, instead of buying the stock, I tend to buy a leap, something further out, and then I sell weekly calls against that leap.
Yep.
So generating a weekly income off that, 6 to 9 months, however far out they want to go.
Yep.
So that's my individual stock go-to theory or go-to strategy, and otherwise SPX and on a weekly basis.
Yep. So you buy a leap and then you just against that sell the calls.
Yep. On a weekly basis.
Okay.
And also another thing I like about the weekly aspect of it is that, let's just say the stock starts to move, at least I have the advantage of each week readjusting where I want that call, the one I'm selling.
Yeah, sure.
So I can move it up, whatever, wherever it has to be, as opposed to selling something further out and kind of being, I draw my line in the sand way out there, and there's not much I can do about it if it moves.
Right.
So I'd rather be able to adjust every week.
Yeah, no, I understand. Well, that's really part of why what I like to do is I like to, let's say right now, we'll draw that line in the sand using, let's say, April options, but I'm not keeping the trade on average beyond 2 weeks. So that's still then, it's kind of the same thinking, because I don't want to have to draw the line all the way out to April. I'm really only draw the line out 2 weeks. Right?
So you don't go for 100% profit. You just want to put it on.
Oh God, no. Maybe 50%, 30.
Yeah.
And again, it's just if you look at what has killed the traditional hedge fund in the way it was originally constructed is essentially pension funds coming into becoming major hedge fund investors, which is now pension funds and institutional investors. And when they came into that business, what they demanded over time more and more was good returns with zero volatility, or little volatility. But what that doesn't allow for is an actual real trade. You basically have to be so short term, and so I think that's a problem in the industry, and it also compresses volatility in the markets.
I noticed you had another trade that you referred to a lot was your morning trade, your 0 days expiration, like you tried to trade a gap in the morning and make a quick.
Oh, the gap, yeah. I mean, that's not an options trade. That's basically just, what you have in the morning is you have stocks either gapping up or down. And then what tends to happen a good amount of times, you'll see the gap close. Like today, we did today's gap trade that we did that closed was in, what the heck was it? Some stock, Alibaba, I can't remember. Win. And so the stock gap lower. And then as the market reversed the stock, so it's an easy concept, but there are things you need to watch, and it actually also is what's important in that is the whole sector and group thing. Mm-hmm. So if you have you can imagine if a stock gap's lower, let's say it's MU, Micron Technology. What you want to watch is not just that stock, but you want to watch, say, the ETF, which is the SMH, semiconductors. If that thing starts to move higher, then you have a good chance of MU moving higher, and at least you want to keep an eye on that. And I think a lot of people will just forget that. They say, MU is gapping down or gapping up, let's do a trade. But unless and of course the broader market's important as well. So
then you don't sell options on that gap. You actually buy or sell the stock.
Yes. I mean, what we'll really do is basically buy an at-the-money call expiring whatever. That one will go short-term because the trade's only open for an hour or something, or less, or 15 minutes. So, but have you done anything like that before, or are you?
No.
Mostly options?
Actually, no. We tend to put our trades on Thursday for the following Friday.
Oh, okay.
And, basically Thursday, so we can collect the weekend's time decay.
Sure.
And that's usually the length of our trades are a week.
Yeah, sure. And then when do you get out of that trade?
Thursday. Usually the
Next Thursday.
Yeah. Usually what the first thing we'll do is, as soon as we put the trade on, we'll put on a nickel closing order for both sides. So if we can, a lot of times we'll close on Tuesday, Wednesday.
Yeah.
And then whatever size left, we'll watch that one and then close that out usually by Thursday.
And what do? You sell a call spread or a put spread or what do you do?
Both, iron condor.
You're iron condor. Okay.
If the market, and unless, like in this market, no, because this market is too parabolic.
Yeah.
So in this case, it would be put spreads, but normally
put spreads right now. Okay.
Yeah, but normally, if it's a regular, a normally living market, we would try to do both sides.
Yep. And how do you deal? And this is always interesting to me. How do you deal with volatility in this? Because I mean, as we said earlier, I don't know if this was before we went live or not, but in a market that goes parabolic doesn't correct orderly; it corrects sharply. So I guess because you only in it. Well, maybe you close out early if you see it reverse, or how does that? Yeah.
Well, the worst case, I'll put my stop at the money. So yeah. I don't want the position to go in the money. So at worst case, I'll close it out when it hits that point.
Yep.
So at that point, we're like, it's like 50 delta. So at least that's better than waiting until it goes much higher than 50.
Yeah, sure.
Worst case. But I found usually at 10 delta, it gives you a good amount of breathing room.
Mm-hmm.
And other trades that we love doing is, which is I asked you earlier, that was the futures. I love doing options on futures.
Yep.
They seem way more mellow, more predictable. If you pick the right ones. I mean, of course, I wouldn't want to pick oil when they're shooting rockets over there or something like that. But normally other ones are pretty manageable. And if you do 10 deltas, it takes quite a bit of something going on for your positions to hit top or bottom on that iron condor.
Yeah. No, I agree. I mean, it does it matter for you whether the VIX is at 12 or at 20? Is it 10 deltas?
If the VIX is at 20, you're going to get more premium, more volatility.
Yeah.
But no, I would actually prefer more volatility in reality.
Okay. Yeah, no, I agree. I was just curious how you were thinking about that. Yeah, no, that's interesting.
Matter of fact, 2008 was a great year.
Yeah.
If you're selling options.
Oh, yeah. And there have been some really good periods for that. Like even like 2011, I remember there was a period in the autumn, I think it was August, September, that was just unbelievable. It's like just create like 2, 3, 4% swings in the S&P every day. It was just totally bananas.
Yeah.
But range bound,
Yeah. I know. Yeah. And those are great times for option sellers.
Yeah.
And I assume as far as technical analysis goes, do you have any preferred methods that you use to make your decisions? Any kind of preferred?
Yeah, what I like to do is I a long time ago developed something called like a candlestick reversal pattern, bullish and bearish, and it doesn't just look at a candlestick. That wouldn't work. It's too simplistic. But it takes into calculate. I think we programmed it for like 4.5 years. Not because the input's not complicated, but it looks. The key point is what is the input, and so basically what it looks for is like a very specific variation of a candlestick reversal. Usually it's a 3-day thing, and it takes into consideration trend and momentum. So it's sort of a 3-pronged algorithm, and so I like to use that for confirmation of things. And it's nice if that also, from a basic technical perspective, bounces off of moving averages or whatever, that kind of stuff.
So someone said to you, okay, for the next 2 months on your charts, you can have one indicator. That's it. What would you pick?
Yeah. Well, it depends what they do, right? So like for options, like for the classic option selling that we do, we have an indicator that peaks, that looks for extremities of overbought, like really crazy overbought or oversold, right? Oh, yeah. And then what we'll do is we'll wait for the indicator to give us the all clear, and then we'll go ahead and in the case of a severe overbought, we'll sell way out of the money call spreads, and vice versa on the.
So is it like RSI on steroids or something? Or?
Yeah, it goes in that direction. Yeah, there's a couple things in there, but yeah, it's RSI. I think is a bit too simplistic, but it looks for standard deviations and things like that, and it just and that works nicely because it's, again, this is where investor psychology comes in again, right? It's the way we look, right? I mean, the way you can look at it is you can say, okay, well, this thing's become parabolic, but at some point you'll start to see patterns where there's buyer exhaustion, meaning there's no more buyers left, right? When everyone that was short or wanted to buy has bought and there's no more buyers left, what has to happen? It probably has to at least consolidate, right?
Yep.
So I don't know. Do you use anything like that, or what do you do when you have a parabolic move?
If you want me to answer my own question first, if I had to only use one indicator for my trading in general,
yeah,
I would go with swing points.
Okay.
To me, if I watch swing points, I think that's the best way to, let's say, read the tape.
Yep.
And track it.
Yep.
And as far as other things, parabolic SAR is another one of my favorites.
And you use that on what time frames?
Daily.
Daily.
Yeah.
Do you pay any attention to like weekly or monthly time frames, or how do you?
If I'm trading Forex, yes.
Yeah.
If I'm doing SPX, no.
Not so much. Okay.
No, only because my trades are a week anyway. So
right,
no.
right.
Yeah. So I don't really need anything bigger. I don't need anything smaller.
Yep.
Forex, yes, because Forex, I use 4 hours, I use 1 hour, I use weeklies, because I'm trying to get confirmation on a lot of different time frames.
Yeah. Interesting. And when you do those trades, do you pay any attention to I don't know, like, if there's an event, like when you do the weekly trade?
Binary, say? Yes. Oh, yeah.
Yeah.
But that's also sometimes can be a good trade, because there's a binary event coming up, you might have, volatility is going to increase coming up to that announcement, that event.
Yep.
It's going to be. And then you're going to have what I call volatility implosion right at the event, because once the unknown becomes known, the volatility is going to dry up. Whether it's good news, bad news, whatever, you're still going to lose the volatility.
Yeah.
That's always a good trade. Usually.
Yeah, I agree. It's really interesting. I was just in London a few weeks ago, and we were doing some news media interviews and things like that. And of course, they have Brexit going on,
mm-hmm.
and so we had a room full of people. We were talking about kind of like how do you trade all this, and I think it's a very difficult situation right now. But there was a trade that we did into the Brexit boat. And if you can pull up a chart, or any of the viewers at some point, and you can, I think it was it 2016? Was the,
no, I think.
Was it 18?
I think it was, yeah. I remember I was in a hotel room at the time. I was watching the futures.
Yeah, it was incredible. And so what ended up happening is, I think the Brexit was like an end of June. Mm-hmm. And I found myself like the first week of June with 2 weeks to go, and I looked at and I was looking at the UK markets as well, but I was even just simplistically looking at the VIX and S&Ps, and I was like, how is it that the VIX was 12, 13, 14, whatever, low, right? With 2 weeks to go, it's just impossible. So we loaded up on basically straddles that we bought. Mm-hmm. Which just in that case would make money if the volatility increases, and it did. And it's just been one of the better trades in terms of non-directionally being right, just volatility increasing. And of course, you close it way before the vote, otherwise it's crazy. But it amazes me how markets sometimes just don't care, right. And then they price it in very quickly.
Yeah. Well, I know we're getting close to you said you had 45 minutes to devote to this. So we
can go another 5 minutes, not a problem.
If you say you were talking with a beginning trader or someone that wanted to start trading, what advice would you give them? What tips would you give them? What words of wisdom?
I think the most important thing, and I think we touched on it earlier, is to give it time, and don't expect much or anything for a while. And I know a lot of people don't want to hear that. In fact, no one wants to hear that, but it's the truth, And it's like we said earlier, if you've never lifted a weight before and you have no expectation to do 2 bicep curls and be bulk, you won't. You know that. But in the markets, people think it's different. It's not different. In fact, it's probably even more the other direction. It takes even more work here, But I think that's really the number one thing. I mean, it's And I think that, and maybe that's too early at a level to give this following thing, but I think as someone progresses, I would really encourage them to yes, learn your charts and all those things, but really be willing to go deeper and understand that economic cycles matter more than anything. Growth, rates of growth, just learn how to read economic data points. You don't have to become a PhD or an economist. In fact, that might be detrimental. But, learn about interest rate cycles. That's important. That is the dog that wags the tail and not the other way around.
So if people want to get a hold of you and check out all the things you offer, how will they do that? Where should they go?
Yeah, they can go to thesteadytrader.com. But there actually is, if people want to, if they want to get into this option selling stuff, which ultimately, and I think you would agree, is probably the higher, right? Probably the thing to do, right? They can actually go to, I have that indicator available. They can install on their platforms, and they can just go to, I think it's steadytradersecrets.com/cash. Is that for? But it's steadytradersecrets.com/cash. And what they'll be able to do is get that indicator, and they can install it on their platforms. They get a course with it and ongoing webinars that we do at least every other month, probably more like every month. And then we really teach them how to generate that income. And so I on average roughly between 50 and 70% a year returns on that. And it works with small accounts. I mean, last year I opened a small $5,000 account just to show people that you can make money, and we ended up with a $9,000 account at the end of the year. So, the option selling, and I know your testimony to that, it really works.
Now, this indicator is free?
No, they pay for it. It's not expensive. I think
it's a subscription kind of deal then.
It's a one-time thing. I think they pay $297, and that's it. And then, then they own it, and then they get the course with it. They get the indicator. Then they can install it wherever they want.
Okay.
And of course, you get the ongoing webinars. So we do, like I said, we do almost monthly webinars. They're membered webinars, and we've done them for years and years and years. Where we not only do we of course help them how to use it and teach them how to put on the spreads, but also what we'll do is we will live scan the market. Like, for example, just today, actually this morning, did one of these webinars, and we went through it and gave them actionable live trade ideas so they can actually do trades.
Okay. I'll put both of those links at the bottom of this video.
That's great. That's great, Ron.
Okay. Well, I just want to say thanks for coming on. It's been a pleasure. I love talking to people that talk the same language. It's it's fun. It's refreshing.
Thank you, Ron. It's been a real pleasure. And I'm going to look into your selling leaps or buying the leap and selling options against it.
The return is much better on that because you got your cost barrier is lower. You don't have to actually buy the stock.
No, I understand. So
it's good. Okay. Well, great.
Thanks, Ron. I appreciate it.
All right. Thank you. Bye-bye.
Take care.